The most dangerous person to your money isn't a scammer or a banker or some politician on TV. Every year, ordinary people put their savings into the market, follow all the advice, buy the right things, and still walk away with half of what they should have earned. Half. And here's what nobody warns you about before you start. The market didn't take it from them. They handed it over themselves and never even noticed. There's one number, buried in decades of data, that proves it. The reason most investors quietly lose to a boring index fund a beginner could buy in 10 minutes. Stay with me. By the end, I'll show you that number and the one enemy you have to beat before you invest a single dollar. And no, it's not who you think. If we haven't met, I'm Sargon, and this is Strategy State, the channel where we cut through the noise around money and look at what the numbers actually say. Today is about the things you need to know before you start investing. Not the recycled tips you've heard 100 times, the stuff that quietly decides whether you build wealth or slowly bleed it. Let's get into it. Go anywhere online where people talk about money, and you'll see the same question on repeat. What should I buy? What's the next big stock? Everybody's hunting for one magic ticker that changes their life. But here's the uncomfortable part. What you buy matters far less than almost anyone will tell you. The what is not where fortunes are won and lost. So before you put money anywhere, let me walk you through 3 facts. 3 things most people only learn after they've already lost. Fact 1. Before you invest a single dollar, you need a floor under your feet. Right now, only about half of Americans could cover a surprise $1,000 bill from savings. Nearly 1 in 4 have no emergency cushion at all. Why does that matter for investing? Because life doesn't wait for a green day in the market. Your car dies, your hours get cut, and if every dollar you own is in stocks, you're forced to sell at the worst possible moment. That's not investing. That's gambling with a countdown timer running. Then there's the second floor, high-interest debt. The average credit card now charges over 20% a year. The stock market, long-term, returns around 10. Here's a number that should stop you cold. Carry $10,000 on a card at that rate, and the interest alone runs over $160 a month before you've paid off a single cent of what you actually borrowed. You cannot outinvest a 20% interest rate. It's like sprinting up a down escalator. So step 1 isn't a stock at all. It's an emergency fund, and killing any debt that costs you more than the market can ever pay you. Do just that, and you're already ahead of most people who dive straight into trading. Now, fact 2. This is where it gets strange. There's an entire army of professionals, Wall Street's sharpest minds, armed with supercomputers, private data, and billion-dollar research budgets. Their whole job, all day, every day, is to beat the market. So you'd assume they crush it. They don't. Over the last 20 years, more than 90% of professional fund managers failed to beat a simple index fund. In 2025 alone, nearly 8 in 10 large company funds lost to the S&P 500. And once you factor in taxes, the typical fund trailed the index by as much as 4% a year. Sit with that. The people who do this full-time, for a living, mostly lose to a fund that just quietly owns the whole market and does nothing clever at all. So the next time someone swears they've cracked the code with hot picks or day trading, remember exactly who they're up against and how badly the experts are getting beaten. Which brings us to the thing that actually moves the needle. Not the stock, not the timing. Something almost nobody gets excited about because it's slow and quiet and deeply unsexy. Time. Picture 2 people investing the same amount every month. One starts at 25, the other waits until 35. Same money in, same returns, just 10 years apart. By retirement, the early starter can end up with roughly double. Sometimes hundreds of thousands of dollars more, for barely more of their own cash out of pocket. This is compound interest, and it's the closest thing to real magic in all of finance. Take Warren Buffett, worth over $100 billion. Here's the wild part almost nobody mentions. The vast majority of that fortune was built after his 60th birthday. He didn't get rich fast. He got rich for a very, very long time. This is also why trying to time the market, waiting for the perfect moment to jump in, is such a trap. Fidelity ran the numbers on an investor with the worst luck imaginable, someone who bought at the single highest point of the market every year for over 40 years. You'd expect a disaster. Instead, because they never sold and never stopped buying, that unluckiest investor still ended up a multi-millionaire. The lesson is blunt and it's simple. Time in the market beats timing the market, almost every single time. Still not convinced? Over the last 20 years, staying fully invested did great, but miss just the 10 best days, 10 days out of thousands, and your total return gets cut roughly in half. And the cruel twist, most of those explosive days happen in the middle of the worst crashes, right when everyone else is panicking and hitting sell. Which finally brings us to fact 3, the most important one of all. The reason I opened this whole video by telling you the most dangerous person to your money isn't some scammer, because now I can actually prove it. Every year, a research firm called DALBAR measures what the average investor actually earns versus what the market handed them for free. In 2024, the market, the S&P 500, returned about 25%. The average investor, just over 16%. That gap, around 8.5% in a single year, is one of the widest ever recorded. And it is not a one-off. The average investor has now lost to the market 15 years in a row. The last time everyday investors actually beat. It was back in 2009. So where did all that money go? Nowhere clever. They bought when everyone was greedy and prices were high. They panic sold when everyone was terrified and prices were low. Stretch that over 20 years, and the very same starting investment can end up worth half of what a person who did absolutely nothing would have. Same market, same funds. Half the money, surrendered to their own emotions. Morningstar found the exact same pattern. Investors pocketing far less than the funds they owned. So here's the answer to the riddle from the start. The most dangerous person to your money, the one enemy you have to beat before you invest a single dollar, is the one you'll see the second you look up from this screen. It's you. And this matters more right now than almost ever. Americans have more of their money riding on stocks than at any point on record. Nearly half of everything they hold in financial assets. The market's priced richer than it's been in decades. The richest 1% hold more stock than the bottom 90% combined. Even seasoned investors are nervous. Money's pouring into gold, which just smashed record highs, while one classic warning gauge sits at levels rarely seen outside a bubble. You can't control the market. You can't control the headlines, or the crashes, or the noise. But you can control the one thing that actually decides how this ends. Whether you stay calm, stay invested, and let time do the heavy lifting while everyone around you loses their nerve. Because the crash isn't what wipes people out. Selling during the crash is. The headline isn't the danger. Reacting to it is. Every real fortune built in the market was built by people who simply refuse to flinch. So before you start, build your floor, kill your debt, ignore the hot tips, and understand that the boring, patient path quietly beats almost everyone. You don't need to master the market. You need to master yourself. Honestly, that's half the reason I wear the mask. Watching people panic sell at the very bottom is scarier to me than anything hiding under here. If this changed how you think about your money even a little, subscribe and stick around. Strategy State is where we keep it real about building wealth. I'm Sargon. Now go put your money to work, and then try your hardest to leave it alone. I'll see you in the next one.